Okay, so this is lesson 5 of home finance. We need to talk about the other things that you have to worry about in terms of the costs when you buy a house. It's not just your mortgage you got to pay for when you buy a house. There are other things to consider. Here is some of them. Sometimes the bank will actually, before they'll okay a mortgage, they'll want the house appraised as to what it's worth. So since you're the one buying the house, that's on you. So you have to determine the value of the purchase price of the house by hiring a certified appraiser, a certified house inspector. That will also, of course, let you know if there is any damages or problems with the house that you'd have to fix before you started living in it. Say that you wanted to put up a fence or change something about the yard, put a garage on it or something like that. Well, then you need to have the property surveyed so that you know which part of the yard is you own it. And of course, you only own the part that's your yard, the boulevard, the part that the city owns. You need to know where the line is where your property ends. You have to pay a surveyor to do that from the city. There's a fee for that. High ratio mortgages. If you need a high ratio mortgage, which means that you have saved less than 25% for a down payment, you usually need something called CMHC insurance. And CMHC stands for, here, I'll put a little note by that, note. And you write it at the bottom here. There's room at the bottom, note. CMHC stands for Canadian Mortgage and Housing Corporation. That is a government body that makes sure that two things don't happen, or at least don't happen easily. That the bank sells you a mortgage that you just plain can't afford, or that you trick the bank into selling you a mortgage that you can't afford because you want to live in a bigger house than you really can't afford. So it's to try to keep both home buyers and mortgage sellers honest. It's something a lot of countries don't have. The Americans don't have anything like this. And that's why when we had a complete financial collapse in 2008, it was mainly because the American housing market collapsed because there was so much bad debt out there. So many people had mortgages they couldn't afford to pay for, interest rates went up a bit, and the whole thing tumbled like a house of cards. Why didn't Canada get stung that way? Mainly because we have this body that oversees things like mortgages. Now, somebody was asking the other day, how come when we did the online mortgage calculator, we got slightly different answers than we would have got if we'd have used the good old-fashioned PERT formula? And the reason why is because there's always a little bit of this insurance involved. That's the difference. Okay? So, anyway. Next, we're going to do this one specifically together, land transfer tax, which is transferring land fees by some provinces. Usually it's a percent of assessed value. And this can actually be a fairly large amount of money, as we're going to see. We're going to learn how to calculate land transfer tax in the second part of this lesson. Then, what if you buy a house from somebody who already paid for their yearly property taxes before they're selling the house to you? Oh, then you're going to have to reimburse the seller for how much they've already paid in their property taxes, or what if they paid for their cable bill for the year, or they've paid ahead on their water bill. Some people actually pay ahead on their utilities. So you would have to be responsible for reimbursing. So that might be part of the cost of you buying a house. Buying a house is a huge financial decision. You should probably get a lawyer involved. Legal fees and disbursements. That means if money, again, has to be paid out back to the seller because of things like property taxes or utilities, these things should be sorted out by a lawyer. Get a trusted lawyer to look after dealings with home before offer to purchase. Your lawyer can also help you do things like officially file the deed and the title of the house. That means it's the piece of paper that says that, yes, you are the legal owner of the house with the city, because that's a very difficult thing to do yourself. Lawyers tend to take care of that for you. Next, yes, the government wants their chunk. when you buy a house, there is GST on it if it's a new home. A brand new house has GST on it. Used houses don't. That is correct. So if you're the first owner of a house, it has just been built for you, budget in that 5%. GST is on the house. But if it's a used house, it's a resale property, there is no GST. Don't worry, the government gets you on the land transfer taxes. They'll get their chunk, don't worry. Don't forget, it might cost you money to move. When you have to have utilities hooked up, they charge you for that, right? You have to have the phone connected, you have to have the water turned on, the gas turned on. Every one of those things costs $100 or so bucks. You might have to get things fixed to move in. What if you buy a house that doesn't have any appliances? You got to buy your fridge, your stove, your washer, your dryer, your dishwasher. And of course, paint isn't cheap. I love those home renovation shows on the HGTV where they don't really kind of break down how much the actual renovation costs. You'd probably be stunned at how much paint actually costs to have your house painted inside or outside. Carpeting, hardwood, all of those things cost money. So there's kind of a list of the things you have to think about when you're buying a house, in addition to the actual mortgage. Now, we're going to look at one of them, or actually first we're just going to do kind of a general example. So example, the house that Gerald and Amy want to buy costs $210,000. They need 5% of the purchase price for the minimum down payment and 2% of the purchase price for closing costs. So what is the closing cost? The closing costs will be kind of all of these things put together. All of the things we've talked about. You could kind of call them all closing costs. So they need 5% of the price of the house for their down payment. And I've already done the calculation on that. That's $10,500. So that's my down payment. And they need 2%, which I've already done the calculation on that. That's $4,200 for their closing costs. So that's going to pay their lawyer. That's going to pay for the land transfer tax. That's all of those things put together. Yes, it is usually going to work out to somewhere between 2 to 5% of the house. So that's why they just kind of rounded it to 2, or estimating that it's 2. So the total on that is you'd better have another $14,700 on top of your down payment, or on top of what you're budgeting for your mortgage, between your down payment and your closing costs. Okay? Now, so that's just a general example. Let's get a specific example. Built into these closing costs is something called the land transfer tax. And this is one that they, in the curriculum, they want to see if you can figure out for yourself. It's one of the more complicated things we do this course, until you kind of understand the logic of it. Basically, think of the amount that you're buying your home for as, think of this $180,000 that the house costs. You're buying a $180,000 house. Think of that price as a pile of money. And we're going to split it into piles. On the first $30,000, let's take this $100,000 and make a pile of $30,000. So there we go. I've got a pile of money. I'm imagining Scrooge McDuck diving into this pile of money. That's a cartoon reference for you. So in this pile of money, it's $30,000. I don't pay any taxes on that pile. That's nice. The first $30,000 of house that I buy is tax-free. Isn't that nice? Next, the next pile is $60,000. So it's a bigger pile. It's twice as big as the first pile. This is my pile of money. These are gold doubloons I'm drawing here. Big pile of money. This is my $60,000 pile of money. Quick, how much is the two piles so far? What's 30,000 plus 60,000? I want to see if you're awake. Somebody tell me in the chat. How much of the house do I own right now between those two piles of money? They've all fallen asleep out there. Come on. How much is that all together? It's $90,000. So that's $90,000 of the house right there. This pile here, I pay 0.5% on that. So this pile gets taxed at a rate of 0.5%. Then I take another $60,000 pile of money that this house is. So again, let's say I was paying for this house with cash, right? $180,000 in gold doubloons. I made a pile of $30,000. I made a pile of $60,000. Here's another pile of $60,000, but this third pile gets taxed at a higher rate. It gets taxed at 1%. Then a slightly smaller pile, not much, but a little smaller, bigger than the 30%, but smaller. I guess I should make this much bigger, right? It's supposed to be twice as big as that one. I'm going to make this big. Big, big, big. Again, it's a pile of doubloons. You guys don't know what doubloons are. That's like gold coins that pirates used to use. This pile's a little smaller than that one, but bigger than this one. This is my next pile, which is $50,000, and that one gets taxed at 1%, at 1.5%. Okay, now wait a minute though. Hold on. Let's do our adding. 30 plus 60 is 90. 90 plus 60 is 150. Ooh, 150 plus 50,000 is more than this house. This house was only 180. So you know what? This pile actually isn't 50,000. So let's see. Let's add it up again. 60 plus 60 is 120. 120 plus 30 is 150. Oh, this is just another $30,000 pile. But it doesn't matter that this pile isn't as big as the rate could tax it at. That rate stays the same. So I pay no tax on the first part of this, the first pile of money. I pay 0.5% on the next 60,000. I pay 1% on the next 60,000. And then the rest of my house is worth 30,000. I pay 1.5%. So now, let's figure this out. I pay no tax on the first 30,000. I pay 0.05%. Now remember, percents have to be turned into decimals by moving the decimal over twice. So that's 0.5% of $60,000, which is $300. I've already done this calculation. Plus, I have to pay 1% of the next 60,000. There's 1% of the next 60,000, which is $600. Then I pay 1.5% on my next 30,000. So that's 0.015 on my next 30,000. Now, if my house was worth more, I'd keep paying more, right? If there's up to $50,000 more. What if my house was worth even more than that? Anything over 200,000, it's 2% on the rest. So notice the more expensive your house is, the more your land transfer tax is going to cost you, which makes sense. We want to tax rich people more than poorer people because that would be a more fair way to run society. That's not always how it works, but at least it works that way when it comes to land transfer tax. Anyway, 1.5% of 300,000, or sorry, of 30,000 is $450. So add that up. 450 and 600 is 1,003. My total is $1,350 of land transfer tax. Okay, without drawing those weird piles, let's see if we can do the second one. Notice this one's a way more expensive house. I'm definitely going to get into this zone here. So, I am paying 0.005, right? 0.5% on the first $60,000 of house. Let's get the chart in there too so you can see it. There it is. Okay, on the first 30,000, I don't pay anything. So I better make a running total. My house is worth $200,000. On the first 30,000, I don't pay anything. That's 170,000 more of house. On the next 60,000, I'm paying right here. So I'm going to use a highlighter. That right there is right there. So that is now leaving me $110,000 worth of house. Or sorry, how about this is a, wait a minute. Oh, this is a 300, oh, no. Sorry, made a mistake. It's a $300,000 house. So that makes that a 270. That makes that a 210. There we go. Sorry, I misread how much the house is. Okay, anyway, what is this number? We already kind of know this number from up there. It's 300. Now, the next $60,000 of house, which is going to go right here, how much am I paying for that? 1% tax on the next 60,000 of house. So that number is right there. And that number is, again, we already know this from up above, it's 600. But how much house do I still have to pay for? I've paid tax, no tax on the first 30,000. I paid the yellow tax here on the next 60,000. I paid the green tax on the next 60,000. 21 minus 6 is actually still 15. So I still have $150,000 of house to pay for. What's the next? Well, on the next $50,000, I pay 1.5%. So 1.5% on the next $50,000. So I take $50,000 off of this one. Let me use a different colored highlighter again. So on this 50,000 right here, I pay, what's 1.5 of 50,000? $750. But I still have $100,000 more house to pay for. But after I've hit these ranges of taxes here, everything after that's just 2%. So what's left? I have 2% left of $100,000. And 2% of 100,000, you could even do that in your head, that's $2,000. So yeah, that first example was a much lower bill for land transfer tax. This one, add all that up, is $3,650. People buying $500,000 homes are spending a lot of money on land transfer taxes. As well they should. They're rich and they can afford it. And if they're not rich, they shouldn't be buying houses that big because they will crash our economy when they eventually default on their mortgages. All right, there you go. That's the land transfer tax examples. I'm going to stop the video there.